On the morning of May 4th, 2026, the global financial markets opened to highly aggressive, unprecedented, and high-volume volatility. This split-screen chart tracks the immediate market reaction. On the left, you can see energy benchmarks experiencing acute downward pressure. Brent crude futures dropped sharply by 5.12% to $108.17 per barrel. Now look at the right side. As oil fell, Asian equities exploded upward. The Japanese Nikkei 225 surged to a historic intraday record, breaking past the 60,500 mark. This tape is driven by a highly specific algorithmic assumption. Trading desks and institutional algorithms are pricing in the executive branch's announcement of Project Freedom as the definitive end to the Middle Eastern military crisis. But the underlying facts contradict this tape. Global equities are celebrating a return to commercial normalcy, while 20% of the world's seaborne energy remains physically trapped behind a heavily armed active maritime blockade. The actual operational parameters of Project Freedom tell a different story. The initiative is a highly targeted, localized humanitarian extraction protocol designed only to retrieve neutral commercial vessels currently ensnared in the conflict zone. Intelligence outlines show this operation does not rely on direct U.S. Navy warship escorts riding alongside every individual tanker. Instead, it functions through complex, multilateral coordination with allied governments and global maritime insurance syndicates. To execute this, the administration issued a strict, non-negotiable instruction to the extracted vessels. The extracted ships are ordered not to return to the Persian Gulf until total navigational safety is fully restored. This makes the current market optimism a massive mispricing. Project Freedom acts as a targeted emergency extraction protocol, leaving the structural closure of the Strait of Hormuz in place. To understand why the waterway remains closed, we have to look at the military mechanics that began in late February. Targeted kinetic strikes triggered a severe retaliatory closure of the corridor. The situation rapidly devolved into a dual blockade. First, the United States Central Command initiated a stringent naval blockade of Iranian ports, actively turning back commercial vessels and denying Tehran an estimated $5 billion in hydrocarbon revenue. Concurrently, the Iranian Revolutionary Guard Corps demanded unauthorized transit tolls from non-aligned shipping conglomerates, effectively holding neutral vessels hostage in the crossfire. The collateral damage is massive. Asset tracking data confirms over 700 commercial vessels are stranded, including 120 fully laden oil tankers and an estimated 20,000 commercial seafarers. This dual chokehold has effectively severed the central nervous system of global energy transit. The asymmetrical threat of sophisticated naval mines represents the primary logistical hurdle to trade, far exceeding the risk from aerial drones. Clearing these devices requires a transition from traditional post-conflict minesweeping to active, high-risk mine hunting. This graphic compares the two methods. On the surface level, you see traditional sweeping nets, but below, specialized submersibles are executing the meticulous process of scanning the seabed for individual explosive devices, tethered by acoustic or pressure-sensitive cables. The U.S. Navy has deployed highly specialized assets to handle this, including Avenger-class minesweepers, littoral combat ships, and specialized explosive ordnance disposal divers. Military analysts and Pentagon briefings confirm that completely sanitizing the strait of these explosive threats will require a minimum of 6 months of sustained operations. The current supply chain friction is structurally hard-coded into the market through the rest of 2026. This timeline has forced global shipping conglomerates to abandon historical cost optimization models overnight. Procurement logic is now dictated entirely by urgent safety and reliability metrics. Commercial traffic bound for Europe or the American Eastern Seaboard has been aggressively redirected to the Panama Canal, pushing the infrastructure to absolute maximum capacity. This visualization of maritime transit auction disclosures demonstrates the resulting financial pressure. Shipping entities without long-term reservations are forced into last-minute spot auctions to secure passage, with peak emergency bids rapidly exceeding $4 million. The data shows energy conglomerates routinely submitting massive bids to expedite transit, capturing elevated crude oil spot prices while heavily outspending consumer agricultural shippers. There is a strict physical limit to this arbitrage. Ultra-large crude carriers and massive next-generation container vessels are physically incapable of traversing the concrete lock system of the Panama Canal. The physical limits of the canal ensure these transit premiums weigh on downstream corporate margins through the remainder of the 2026 fiscal year. If global energy supply chains are facing severe structural constraints, why are U.S. stock indices currently hovering near fresh all-time highs? The answer is a massive, underreported structural counterbalance. The formalization of a comprehensive economic and trade deal between the United States and China is providing significant support to global markets. The critical technology pillar of this agreement involves China's suspension of global export controls on key rare earth minerals, including gallium, germanium, antimony, and graphite. This specific policy shift removes severe supply bottlenecks for the U.S. domestic semiconductor base, the defense sector, and electric vehicle manufacturing. Reciprocally, the agreement suspends retaliatory tariffs on American commodities and secures long-term purchase commitments for U.S. soybeans through 2028. By securing the flow of critical minerals and reopening agricultural export markets, the United States has fortified its domestic economy against the inflation shocks emanating from the Persian Gulf. For corporate treasurers and institutional allocators, the macroeconomic environment requires a profound adjustment. The weaponization of maritime choke points has forced a move away from just-in-time logistics toward localized resilience. This institutional portfolio pie chart illustrates the necessary capital rotation. The first step involves aggressively draining capital from vulnerable global logistics networks and reweighting towards sovereign energy independence. The demonstrated vulnerability of the Middle East ensures that domestic energy production and North American LNG export infrastructure will command a systemic premium. Next, capital must pivot away from the geopolitical risk heavily concentrated in semiconductor foundries in Taiwan, rotating instead into domestic utility companies. The expansion of the top hyperscalers now depends on physical power generation rather than computing logic. Finally, the allocation moves to capture the sustained expansion of sovereign defense budgets, targeting advanced naval defense systems, radar, and the unmanned submersibles critical for operations like minehunting. These three specific sectors are structurally insulated from the ongoing maritime logistics crisis, offering a mathematically sound path to institutional alpha. The rules for private wealth preservation are also shifting. High net worth individuals and family offices must adapt to a high inflation environment. The recent passage of the One Big Beautiful Bill Act, known as the OBBBA, introduced a novel regulatory catalyst for estate planning. This flowchart outlines the mechanics of the newly established Trump account. It functions as a specialized tax-deferred IRA designed specifically for minors. Crucially, an authorized adult can contribute up to $5,000 annually without the requirement that the minor possess earned income. During the growth period prior to the beneficiary turning 18, the capital compounds entirely tax-deferred, completely insulated from standard distribution restrictions. These accounts become eligible to receive contributions on July 4, 2026. Professional wealth managers must immediately integrate them into multi-generational estate architectures to maximize capital accumulation. Resilience in 2026 requires moving beyond binary reactions to news headlines to focus on the structural shifts that preserve and compound multi-generational wealth.